Welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. As surging Middle East oil tensions and heavy artificial intelligence spending spark volatility across global markets, investors are closely weighing corporate earnings against looming inflation pressures. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual-layered approach that synthesizes macro-level catalysts with technical precision. By cross-referencing fundamental shifts against statistical trends, I execute high-conviction trades where market sentiment meets optimized expectancy. So before we start, please don't forget to like, share, subscribe to our channel for further information about in-depth analysis. You can join our discussion on Discord. The link is on the description box below. So let's begin. So for today, here's the latest on what's going on in the Middle East. So Yemen's Iran-backed Houthis claim responsibility for striking two Saudi oil tankers in the Red Sea, while the United States launched fresh military strikes on Iran, and US President threatened severe retaliation for attacks in the Strait of Hormuz. As hostilities between Washington and Tehran intensified, U.S. Secretary of State Marco Rubio met with Russian Foreign Minister Sergei Lavrov in Manila to discuss bilateral relations and ending the war in Ukraine. Now, U.S. stock futures as well, we see that there was a decline yesterday as investors also closely monitored major technology earnings to see if heavy artificial intelligence spending is translating into real growth. So let's take a look on the stocks. And we also see that there's a mixed tech results, including the Alphabet from the Google, dropping due to higher capital expenditure or the CapEx and forecast, and also the Tesla missing estimates weighed on the market sentiment ahead of the upcoming reports from Microsoft, Meta, and Amazon. Meanwhile, the Asian shares you can see today, it advanced as the regional chip makers as well gain optimism from the ongoing AI investments. And we see as well from the commodities, we have the crude oil, it surged to a 6-week high following escalating Middle East tensions and marked by Houthi militant attacks on Saudi oil tankers in the Red Sea and continued military exchanges involving US and Iranian forces. For the currencies, the Japanese yen hovered near historic lows at 163 per US dollar as traders as well weighed potential rate hikes and also the intervention warnings against ongoing economic pressures. Plus, we have the Australian dollar. It climbed to a 5-week high above that $0.70 following a strong labor report that really increased expectations for further interest rate hikes. And finally, we have seen the offshore yuan, it edged up to approximately 6.77 per dollar and supported by expanding liquidity and rising global demand as China advances its currency internationalization goals. Again, going back to commodities, we've seen the gold. So let's take a look at the chart of gold. It's right now. The doing price is 41.07.64. So the gold and silver prices, they have rebounded due to the bargain hunting, but the markets as well doubt a lasting rally will occur given there is an ongoing market pressures as well. And we see that while the gold, it faces right now a risk of further correction, the silver as well could perform better due to its strong industrial demand. Now, what are the implications of this? On the ongoing, we see on the monetary policy signals. So elevated bond yields, of course, this is one of the signal for the metals, and sticky inflation. It's driven by energy costs, creating a challenging environment for the metals, and also high interest rates raise the opportunity cost of holding non-yielding assets. And for the monetary versus the industrial metal, so while a gold, it remains vulnerable right now to shifting safe haven sentiment and also to the technical signals, the silver, it possesses a structural advantage through its heavy industrial demand in technology and AI infrastructure. For the structural shifts in global reserves, so sustained central bank accumulation of gold, again, it highlights a long-term institutional trend toward diversifying away from fiat currency and sovereign debt. So again, as gold yields no interest, so any shift toward milder monetary policy, it would lowers as well the cost of holding it instead of income generating assets. Next, we have economic news. So to summarize what is going on, so employment in Australia, it rose 76,300 to a record high of 14.82 million in June 2026, and accelerating at the same time. Australia's June unemployment, it held to 4.4% as job growth hit a record high right now with strong gains in both full-time and part-time positions. Plus, we have the South Korea's economy. It's expanded to 0.6% quarter on quarter in the second quarter of 2026, and it is driven by strong semiconductor and machinery exports. We have the U.S. crude oil inventories. Unexpectedly, it increased or rose to 2.011 million barrels in the week ending for July 17. We also have the annual inflation for the United Kingdom. It is to 2.6% for the month of June, and it was also driven by moderating transport and food prices, while their core inflation, it's steady at 2.6%. Now going back to the stocks, so we have the Southwest Airlines, and it's projected as well as strong full-year performance despite missing second quarter revenue expectations. Meanwhile, the Texas Instruments delivered a higher than expected sales forecast, and though investors right now, they remained unimpressed following the stock recent gains. And we have the Tesla. They reported already their second quarter earnings that missed the Wall Street expectations. And despite there's a beating on revenue as heavy spending on the AI and the robotics, it drove the cash flow negative. So profit margins also slid as the company right now, they shifted focus towards robotaxis and humanoid robots, and during these operating costs and increased competition. And we can see as well for the Nikkei 225, it rose to 0.50% to close to 66,445 points, and it was also driven by gains in industrial and paper stocks despite retail sector declines. Meanwhile, we can see as well the European shares, they are set to open lower as escalating Mid-East tensions is really driving up the oil prices, and investors also await the upcoming ECB policy decision. So again, based from the economic calendar that we are looking, we have the ECB rate decision, and that will they maintain the 2.4%? And again, let's go back as well to the Asian markets. So for the Asian stocks, again, we saw a regional chip makers, it rose in gain value from expectations of increased global spending on AI infrastructure. Meanwhile, we see the oil prices surged to $96 a barrel due to escalating geopolitical tensions in the Middle East. So again, here, going back, it's 96. So again, additionally, investors also remain cautious ahead of upcoming tech earnings and central bank decisions, and monitoring as well how inflation and interest rates might be impacted. Next, we have from the Alphabet. So let's take a look as well from the Alphabet. So here, the Alphabet earnings, the second quarter revenue, let's have this a discussion for the Alphabet. Since the Alphabet, they reported already a stronger than expected second quarter revenue, and it was driven by massive growth in its cloud division, but its stock, it dropped because the company raised its 2026 capex or capital expenditure forecast to as much as $205 billion. So here we can see the EPS 2.85, revenue $119.80 billion, and what we are looking right now is the capital expenditure or the capex. So it grew 100% year over year to $44.9 billion in second quarter. So what is the implication of this report to the equity for the Alphabet? First is that the Alphabet stock is caught right now between a strong business growth and there is a heavy cost required to achieve it. So usually because this one is part of the tech stocks and one of the carrying the weight as well of the index. Next, we have a surging cloud revenue that we need to look at as well, and massive enterprise demand that would really prove the company's AI strategy is really working. So it's one of the highlights when you take a look on the tech stocks, particularly for, as an example, for the Alphabet in dealing with the AI. Plus, if there is an increased spending on data centers, again, data centers are heavily impacted whenever energy costs are increasing. So again, given that they have this revenue, but their capital expenditure, will there be a mismatch? Because right now we are in the second half of the 2026. So the next quarter, those will be the valuation that we are going to wait as well. So that means if this capital expenditure, would it be lessened or will it be increased? Because again, what is the main catalyst for this one to include as your variable or to input during your forecast would be the cost as well of the data centers being impacted by the energy cost. Now, increased spending on data centers as well, it has triggered the near-term cash flow pressures and also stock sell-offs. And then again, at the same time, if there is a huge investment gains supported overall the net income, but Wall Street remains closely focused on core cash generation. So that's how we look as well on the financial statements when it comes to stocks like the technology that is really driven right now if there is a massive surge on the spending. And this is not the typical then we see on a manufacturing firm that you can see the operating costs plus the capital in expenditures are almost in positive or matching, or do they align? Because here it's more on the side of the AI. Now, rising expenses and near-term margin pressures as well will continue to create extra volatility for the equity. Next, we have the oil prices. So again, oil prices rise after Rubio says Iran is not serious about a deal. So again, just to highlight or summarize about what's ongoing right now, oil prices rose significantly as escalating conflict and continuous U.S. strikes in the Middle East, and it really would also possible to continue to disrupt the global energy supplies. Now, given the price surge followed statements from the U.S. Secretary, the Iran is not serious about negotiating a diplomatic end to the fighting. So the implications for this one, like again, we see already the Brent crude oil is really on a staggering of $94.07 per barrel. So the financial markets with surging oil costs and geopolitical tensions increase market instability. So there will be a tightening financial conditions, and potentially as well, it would push back anticipated interest rate cuts by the central banks. And for the indicators in economics, so rising energy prices, it would threaten to fuel global inflation while there's a slowing economic output and increasing as well the threat of stagflation that we are always trying to avoid, or how the central banks right now are trying to look at to avoid the stagflation. Now for DXY or the US dollar index, what could be the scenario as well? So if there is ongoing geopolitical tensions and energy-driven inflation fears, it would continue to support safe haven flows and maintaining as well upside momentum toward major technical resistance zone. So if you see right now, well, it hit again the 101.8 for the DXY. Another is for the gold. So right now it's 41,110. It dropped back again. So although the sticky inflation and elevated interest rate paths, it presents as well a challenge for this one. So severe geopolitical risk and safe haven demand preserve a firm underlying bid for the precious metal. So again, as I mentioned yesterday, both increase at the same time, the XY and the gold. We have to look at the same time before it happened. We should look as well if there are central banks are accumulating as well the gold. Next, we have the US stock indices as well. So rising market volatility would tighter as well financial conditions, and stagflationary pressures would create headwinds that would tighten or heighten the downside risk for major equities benchmarks. Now, since we're also talking the gold, so we move to the US 10-year Treasury yield. So US yields yesterday, it rose as investors as well evaluated the Middle East tension that drove the oil prices alongside shifting expectations for the Fed interest rate hikes. And specifically, the 10-year yield increased to 4.659%, and while markets price in a growing probability of upcoming rate increases. Now, since we are also looking on the ECB today, so Eurozone, so it's the inflation, it slowed down to 2.8% in June, and offering as well the ECB a strong reason to keep its deposit facility rate unchanged at 2.25% this week. However, the renewed conflict between the US and Iran, it has pushed the oil prices back up and leaving as well the markets divided on whether the policymakers will hold steady or implement a surprise rate hike that we are trying as much as possible to avoid. Now, financial markets, investors expect the central bank to keep interest rates steady this month while staying open to a possible rate increase later in the year. And for the economic indicators, while inflation, it has already temporarily slowed down, so rising oil prices would threaten as well to drive up costs again in the future. So given that inflation 2.8, will it be enough for the ECB to pause? But given there is the tension again became active, and we can see as well like the Brent, it went to $94 per barrel. That is already what we are looking forward, how the ECB would curb the expected inflation. That is, if they have already factored in, will there be an increase in inflation so that they will implement that specific rate that they would like to stabilize for the country. Next, we have the ECB as well. So again, the ECB is expected to keep its rate to hold at 2.25 to assess the economic impact of renewed fighting in the Middle East. So President Lagarde will face questions on future policy direction and ongoing speculation about her potential early departure from the bank. Now, the impact on this one would be the financial market. So will there be a hawkish pause? So markets view the expected rate hold as a temporary pause rather than the end of monetary tightening and keeping the door open for future hikes. For the financial markets, again, the bonds, yields, and currencies. So fixed income yields face upward pressure from rising energy costs, while the euro holds steady as traders weigh future rate paths. And for the financial markets, so commodity sensitivity, so short-term market sentiment is primarily, it's driven by geopolitical headlines and at the same time, the increasing oil prices rather than those domestic fundamentals. And we see as well the inflation dynamic. So although the headline inflation, it cooled to 2.8%, but surging commodity prices, it would still threaten to reaccelerate price pressures and also force forecast revisions. And another is because of the growth and stagflation concerns. So sluggish Eurozone growth combined with rising energy-driven inflation that would really cause stagflation risk. It would also complicate the ECB's policy path. And there is a second round effects for this one for the indicator. So the current absence of wage price spirals as well to justify the ECB's measured pause instead of aggressive panic hiking. And for the German index, so in terms of its interest rate sensitivity, since it is an export heavy index, so the DAX would remain vulnerable right now to monetary tightening because higher borrowing costs, it would compress also the corporate equity valuations. And again, if there is a hawkish pivot risk for the German index, of course, while there is a rate pause offers as well a short-term stability and aggressive signals of autumn hikes, it could also derail the DAX rally. Whereas if there's a confirmed rate peak, would also remove a major market overhang. So again, that's how we look on the ECB decision of the president. And at the same time, not only that, what we need to include to our variables, we have the catalyst for the increasing price of the oil, plus we have the Middle East tension. So if this, as I mentioned a week ago, if this tension will not be resolved that much, we can see some economies as well will have forecast or projection forecast in terms of the global growth or per region. It's because if one of the heavily impacted by this inflation, those countries who heavily rely from importing energy. So again, if the specific country is a heavy energy importer, plus if their indices is also heavily impacted by this energy costs, we expect a downgrade of the forecast. So again, in terms of the economics, we are also always on looking forward what could be on the next half or the next quarter. So that's how we look on the projection. Now, moving forward, let's go to the S&P 500. So again, we have the gold right now. You can see it's 41.05. It went to 41.66 level. So now it went to 41.05. Let's take a look on the daily chart as well and how the Bollinger Band as well. So we can see right now on the daily chart, it's trying to clutch on the upper band of the Bollinger, and at the same time we can see the RSI as well performing. However, at this moment, what we need to watch out is the oil prices. So the oil prices, it will give as well a market bearish signal across the indices, because particularly indices that are mostly in the manufacturing. So let's take a look on the S&P 500. So this is the prices I plotted based on lower time frame or different lower time frame plus on a daily and weekly. So why we look at different levels right now? Because again, we are at the closing of the end of the closing of the week. That will be tomorrow. We also have expectations from the US jobless claims. So labor market is also right now heavily monitored by the Fed so that they would have a projection of their decision in terms of the interest rate. So it's not just the inflation itself, but rather focusing on the labor market. So if the labor market is this heavily impacted as well by the AI, since there were massive layoffs last time. Now, S&P 500, just to give an update, so it fell for the fourth time in 5 days as losses major in tech stocks and outweighed gains in other sectors. So the big tech shares decline. Again, we are always monitoring like the FANG or the Facebook, Amazon, Alphabet, Nvidia, and Google. So these are the stocks that we always track in terms of carrying the weight of the indices. Now, because the big techs decline, it was led by drops in Meta Platforms and Microsoft. While we see there is a surge of scores as expected with the energy stocks because of the oil prices that are also rising. And oil prices, it climbed because of the tension with the US and also signaling they are not ready to return to negotiation. So again, if we look on that, there is no um, finalized decision in terms of the negotiation. We look on the commodities, not only for the oil, but rather for the wheat and other crops that would be heavily impacted. Again, if this chain reaction from all the commodities would surge, expect on the consumer prices as well. It will be passed on to consumer prices as a tax because there is a blockade in the Persian Gulf. Now, just to have, again, what are the stocks that we need to watch for this specific index? Again, big tech earnings are already testing investor patience with heavy AI spending. Again, way back 3 or 4 years ago, AI spending was not much became a topic because, again, the United States back then was also into fiscal as well. So there was a time that they had started massive layoffs plus the AI spending. Now we can see right now why is being becoming a reality right now to look at the AI spending. It's because with the data centers. Another thing that is being driven right now is the data centers because back then energy cost was not as high as not we are expecting or what we are currently experiencing. So again, as shown, when Alphabet beat earnings expectations, yet we saw a mix after hours movement because markets demand proof that massive infrastructure as well costs are paying off quickly. So given here, market direction for the S&P 500, it depends heavily on the Magnificent Seven. So we know these are the stocks that we have to look at. So and other top tier mega cap stocks. So given the historic concentration, it leaves as well roughly 38% of the entire index weight resting in its top 10 companies alone. So again, when we look on the index, it's not just we look at this movement. How are we going to look on the movement of this index? We need to look the top 10 performers from time to time. And again, given we are here already on the Q2 and looking at the earnings report, we can see the volatility of the movement, particularly to less than 30 minutes to 5 minutes of the chart. So given that, we expect as well, like this one, we can see there will be trade gaps during whenever they release the earnings report. So again, the S&P 500 index weight is heavily concentrated across the key mega cap like the Nvidia. So approximately Nvidia is around 7.3% to 7.5% as the primary AI bellwether. We also have the Apple. It's about 7.0% driving consumer hardware sentiment. We have the Alphabet, of course, the Google, so holding a combined 5.9% across advertising and cloud. Plus, we have the Microsoft as well at 4.3% to 4.5%. So it anchors as well the enterprise software and the cloud profitability. And this heavy index weight is further supported by the Amazon, and also we have the Broadcom, and we also have the Meta platforms for digital advertising and AI spending. And finally, the lastly is the Tesla at 2.1%, acting as a volatile driver for consumer discretionary and EV trends. So that's how when we look or trade with the S&P 500. So given this one, we look at even the lowest time frame because of the earnings report during the second quarter of the year. Plus, next week would we expect as well the unemployment rate. So given that we are being squeezed by the data during between July to August, and next week as well the start of corporate earnings report as well from the energy stocks until the first and second week of August. So that's how we track as well for this index during the second quarter. Again, if there is a Fed blackout in rates, so the broader market is operating entirely within the Fed media blackout period ahead of the July 28 to 29 FOMC meeting. So with the Fed funds rate expected to remain anchored at 3.50 to 3.75% range. So expectations are locked on a hawkish holding pattern, and at the same time, persistent sticky inflation driven by energy volatility. It really has essentially sidelined rate cut hopes for the near term. Let's take a look on daily. We also look on the side of the energy supply shocks plus the data docket. That means for the energy, of course, the WTI, so it's elevated already near the low of 80s, and the Brent pacing as well higher. So sustained high energy costs, it acts as well as subtle tax on consumers and pressure point for corporate margins, and reinforcing caution across broader cyclical equities. And for the data docket, of course, today's initial jobless claims. So again, it continues to highlight a resilient labor market and mitigating as well hard landing fears, but giving the Fed little justification as well to pivot this dovishly. And we also have on Friday the upcoming June new home sales. So this report will further illustrate how elevated mortgage rates are impacting already the housing momentum, given they have not yet looking at the expected interest rate. So again, earnings catalyst. So for the tomorrow and today, so this 48-hour window hits into its heaviest traffic of the second quarter earnings season. So again, mega cap tech and AI, Alphabet, Tesla, IBM, and Texas midweek, and followed by also by Intel. So while aggregate S&P 500 year-over-year earnings growth is tracking strongly, estimated above 20%. Again, when we track on this one, we have already an estimation of 20% that you can already factor in for your formula to project what could be the movement of the S&P 500. So again, the market's immediate sensitivity lies in the capital expenditure guidance. It's what we are looking right now, the capital expenditure guidance for AI infrastructure and data center scaling. So any signs of diminishing returns on tech hyperscaler expanding, it could also quickly magnify again the index-wide pullbacks due to heavy sector concentration. So again, we can see here the moving averages as well, that the recent slide beneath the 50-day moving average, it marks as well there's as a shift from a frictionless upward trajectory to a range-bound consolidation phase. For the momentum, we can see the RSI and ATR. So again, on intraday and short-term daily charts, you can see, let's take a look on the 1 hour chart. The RSI is hovering neutral to soft territory without hitting as well the oversold extremes, reflecting there is a hesitant on the bullish interest as well. Now, utilizing baseline tools like this, the 20 MA period or RSI and the ATR, it highlights as well there is a compressed momentum, meaning breakouts or breakdowns of the current weekly range could trigger as well accelerated or volatility driven moves. That's why we have to be very cautious before end of the week with how is going to trigger, because we have a tension in the Middle East that is ongoing, plus will there be as upcoming surge again of oil prices that would shock the market. So again, resistance immediate here, we can see where there is a recent step in onto cap rally. So again, 75.05 is based from the hourly chart I'm looking at. This is the price level to break to surge above or past the 75 going to 76, and this is 76,000 level. This is the main price ceiling where the sellers keep stopping the market from rising, and the index need a strong daily close above it to open the door back towards the new record highs. From the hourly chart again, the resistance level I'm looking is 75.24 plus at the same time the 74.65 base from the hourly chart next to the bracket range to target. So again, you can see this is the weekly, the daily of the chart. So again, if oil will continue further to uptrend, again, higher energy costs, it would push the inflation and the bonds yield up, and which also increases the discount rate, and disproportionately as well, it would drag down the valuations of these big tech stocks that really anchor the entire S&P 500 index. So again, this 76,000, this is the main ceiling price that we look at. And again, we can see as well the support level, so 74.65 to 73.35. And again, the Bollinger Bands, you can see it is consolidating relative to the band. So with the upper as well and lower bands providing outer volatility and parameters, while the price it also float near the baseline. For the EMA as well, the 50, so it is tracking right now horizontally around this level of 73, at the same time 7309.1, and acting as a underlying trend filter well below the current spot prices. And the RSI again indicating as well neutral to slightly bullish momentum bias without signaling overbought or oversold extremes. And the ATR as well, the 14 ATR, it sits right now illustrating the magnitude of the ongoing daily price fluctuations across the index. So that's it for the S&P 500 and the rest of the market updates for today. Any questions relevant to the market analysis today? Okay, that's it. So again, now if you want to join, just scan the code and start tracking the markets. And again, you can also join our Discord. The link is on the description box below. You can also check our copy trading. So here's our, sorry for the copy trading. And you can also check our portfolio. So head over to our website, acy.com, and go to this news analysis section and go to the latest section as well. You can see that we have analysis or portfolio insights relevant to the markets. So for the price action, we have Mr. Rafi Grant Capascio for education and market analysis as well. So we provide here guide for specific assets or trading. So you may take a look at it. So today I provided for the EIA crude oil inventories and how this report moves prices. So we have examples of trading for basic, and at the same time we can take a look as well the portfolio insights I provided, which are the past, plus also on terms of technical indicators, because again we are in terms of EI report, we're trading a commodity, the oil. Now, again, markets are moving fast, so stick to the plan and secure our lead and make it happen. So thank you for joining, and I hope today's session provided you with some actionable insights. Have no fear, Ira is here, all is well, and thank you for watching. See you on the next live session.